Okay, folks, welcome to our follow-up commentary with regard to our TWLO trade. The trade is an options trade using a strategy called a strangle. In this trade, we are the casino, not the gambler. The irony of that comment is that in this case, this is an instance where the casino is being challenged and we need to manage the trade. I'm going to talk to you about how we're managing that trade. I'm not going to talk about what a strangle is all too much. I'll go over it briefly, but you can go back to this video here. I posted it on the 27th of October. It's on my channel, so go check it out. It's a really in-depth commentary of the trade itself. This is really going to be a commentary with regard to what we're doing with the management of the trade, because I spoke about it the other day. I didn't think it was fair to not readdress what we're doing with the trade since I talked about it. And the fact that the trade went against us, and everybody wants to talk about their winners on YouTube. Let's talk about trades that are challenging us and what we're doing about it. So, again, I'm going to link this at the end of this video, or if you want to watch this video first, go ahead, then come back to this video, so that way you're up to speed on the trade in its entirety. Okay, a bit about TWLO. TWLO is a cloud-based software stock. It is now currently down on the year. Its 3-year sales growth rate, 63%, very impressive. But their EPS on a forward-looking basis really took a hit. And the beta, the measure of volatility, is very high. Any reading above 1 is a volatile stock. And according to IBD, Investors Business Daily's rankings, the group relative strength is very strong. And this is something to keep in mind. And unfortunately, their accumulation distribution rating is a D-. That's the second lowest that you could have under IBD's rankings. So this snapshot in time is clearly not a good one for TWLO. You could see that back as recently as September the 7th, TWLO had an 80 relative strength rating, which is very impressive. Now that has dropped to 13. So life comes at you fast. Let's talk about the trade a little bit as a reminder. Prior to earnings, we opened up a trade, and this is immediately prior. We opened up a trade. We sold to open call options at a strike price of $395 per share with an expiration of Friday, the 29th of October. Simultaneously, we opened up 305 put options. We sold those options, generating a credit, and the credits combined that we were paid brought our basis cost down to $302 per share. So that was our break even on TWLO. Unfortunately for us, the shares closed out the week at $291.36. So we're underwater on this trade. So the question is, what did we do about it? Well, there's a strategy behind it. So let's talk about what we did. Okay, so now what you're looking at is a daily chart of TWLO. And what we did on Friday is that we closed out the $395 strike price and the $305 strike price, and we rolled the trade. Meaning, at the same exact time as we closed out the old trade, we opened up a new trade, rolling the trade forward. But this time, we adjusted the untested side, meaning we had a $395. We had a profit in the $395 strike price. We rolled that all the way down to a $315 strike. At the same time, we rolled forward the tested side, meaning the $305 strike price, into the following week. We collected a new credit, bringing our basis cost down to $300.63, adjusted for some insurance that I wanted to put on. Because remember, stocks are cyclical. This is a very high beta stock. For all I know, this thing could open up on Monday, Tuesday morning, back above one or both of these support levels, and all of a sudden I'm stuck having to manage a $315 strike price call that is now a naked call option. I don't want to deal with that. I don't want to be too aggressive with my call writing. We're managing our trade. We're managing our risk. So what we did is that due to that concern of a test of the $315 strike price, I purchased a $320 call option just in case we see a spike up higher. That way I have insurance. I have limited downside risk if the shares pop up higher. And you may be saying, well, the stock is beaten up. It could go lower. Well, that's all hypotheticals. Those are all maybes. We don't want to deal in maybes. We want to prepare for the worst, but hope for the best. So we put on some very, very cheap insurance. That way I can sleep at night. Because you don't want to go from one problem into a new problem. So moving into the new trading week, we know our break even is right here. So come this Friday, even though I've sold the 305 strike, if we close above $300 per share at a bare minimum, I'll break even. I could exit the trade. Now, if we fail to recapture $300 per share, well, we may roll the trade forward. Unless, of course, the chart just doesn't look healthy enough and we may need to close out the trade and accept the loss. But we know that we have historical support below where we bounced off of. What's concerning is that where we had support going into the trade, unfortunately, that support level now becomes resistance. So if we rally up into the 305, 306 mark, we're going to look to close out this trade. I will not wait until Friday because we'll have a profit, or at worst at that level, a break even, and we can look to exit stage right. Now let's talk a little bit about probabilities. Now, this is a probability calculator. I always use implied volatility, or historical volatility, I should say. That is the worst case scenario. And this for us right here is the worst case scenario because ideally the shares close above 305 but below 315 by November the 5th. But you could see the probability is very, very low of that happening. And we need to go into the trade armed with this knowledge. The math is telling us that the probabilities are very, very low that this is going to happen. We have a greater probability of the shares trading above that 315 strike, which is why we put the insurance policy on. And the probability of trading below 305, the 305 strike, is very high and is most likely going to be the outcome by November the 5th. But let's keep one thing in mind. When we went into this trade, we had a 10% probability using a probability calculator of the shares trading down below 305. But what the probability calculators do not take into account, you always need to remember this, probability calculators do not take into account binary events. What's a binary event? Well, earnings, a CEO leaving, or COO in this case leaving, forward-looking guidance not being what the street wanted. So going into a trade where you have a definite binary event coming, which is earnings, it was on the calendar. You can't put too many eggs into your probability calculator basket. You need to use technical analysis, market maker anticipated moves, and to a lesser extent, your probability calculator, because the probability calculator takes into account the price action over the past year. Now, how do I feel about the probability of profit, the pop on this trade? Pretty good. And here's why. This is from TOSS. That's Thinkorswim. And when we're doing a trade like this, where we're just looking to break even, make a couple of bucks, just to exit the trade, I have no real desire to hold the trade until November the 5th because I know my probabilities are not working out in my favor. And sure, yes, the chance of a strong counter trend rally is pretty good because we had a binary event. Shorts are going to book profits. So the odds are probably better than what we're looking at here on Thinkorswim, that we're going to have our 305 strike tested this coming week and maybe even the 315 strike. So what are the probabilities of those strike prices getting challenged? Well, I switched this setting from, this is under the Analyze tab, from in the money to just simply touching. And what I do is I take a look at the, you can never get it exact. Here we go. This is the probability of the shares touching the 305 mark between now and the end of business on Friday, November the 5th. And there's a probability of 55.71% that we touch the 305 strike. Remember, our break even is down here at around $300 per share. So within this range, the $300 range to the 305 range, we're good. We're happy. And there's a probability of the market challenging our 315 call side strike of about 31%, maybe a little bit more. But remember, we have insurance up here at 320. So we're protected from a catastrophic gap up higher. So that is the game plan on Twilio moving forward, folks. This is how you roll out a trade. If you have any questions, leave a comment below. Share, like, follow. You know the deal. Everybody enjoy your Halloween, and I'll talk to you soon. Be well.